Hi CA students, let's revise AFM AFM Chapter 13 Business Valuation Illustration 5. Compute EVA of A Limited with the following information. Profit and loss and balance sheet of A Limited is given, and assume bad debts provision of 20 lakhs is included in the SGA, and same amount is reduced from the trade receivables and current assets. SGA is nothing but this selling, general and admin expenses, and this bad debts is removed from balance sheet item trade receivables also. Okay. Also assume that the pre-tax cost of debt is 12%, tax rate is 30%, and cost of equity is nothing but KE 8.45%. Okay. Now they are asking us to calculate the EVA, enterprise economic value added. So EVA equal to economic value added. For that, the formula will be NOPAT minus capital charge. So NOPAT minus capital charge. This capital charge is nothing but the invested capital multiplied by weighted average cost of capital of the firm. So we need two things, one is NOPAT and then invested capital, and then weighted average cost of capital also. So three things are required. So first we'll go with this NOPAT. So NOPAT means net operating profit after tax, and since we are calculating economic value added, this has to be adjusted for non-cash items. So from the balance sheet we have this EBIT, earnings before interest and tax, which is nothing but 410. On that we will be adjusting the taxes, which is around 30%, and non-cash expenses we have to add back, which is nothing but provision for bad and doubtful debts, to arrive at the operating profit made out of the core business activities. So this gives us the core business activities operating profit before interest and before after taxes. These cash items are to be eliminated because cash items are for some financial reporting frameworks, but as an investor they'll not require all those things. They just want how much is the cash profit after taxes. Hence this net operating profit after taxes adjusted for non-cash items will give us the NOPAT, and then we'll be reducing the capital charge. How much is the cost for this invested capital? So we need the weighted average cost of capital because the firm might have both debt and equity. So the invested capital's cost we have to eliminate from the NOPAT. Now finding out the invested capital is nothing but the long-term funds invested by both equity and debt holders that are used in core operations of business. Hence this we can find it out by the total assets which are employed in the business. So in our case it is 1300 minus the non-interest bearing liabilities. So these are nothing but the current liabilities and provisions, wherein interest is these are current liabilities which forms part of the working capital. So hence this will be eliminated from the assets, and cash adjustment has to be added back, because in current liabilities this 20 has been reduced. As per the balance sheet, this 300 whatever we have, it includes this trade receivables also. On that this 20 was reduced, so we have to add it back to arrive at the correct invested capital. So if we add back 20, then the invested capital is 920. Okay, now we got the invested capital which is adjusted for non-cash items. Now we need to find out weighted average cost of capital. So weighted average cost of capital, the formula will be cost of equity plus cost of debt, and Okay, we know the cost of debt is 12 percentage, and we have to find out, we know the cost of capital of cost of equity also for 8.45, but tax portion has to be reduced from this cost of debt 30 percentage. So this 12 percentage minus 30 percentage will come up to 8.4 percentage. So this is 8.4 percentage, then this is 8.45 percentage. Then adjusting with the weights, so the total weight will be equity plus debt. So equity portion, reserves belongs to equity shareholders, so this will be 800, and then the debt will be 100. So 800 divided by 900 into equity portion. This is nothing but KE multiplied by E by E plus D plus KD multiplied by DE plus E plus D. So these are the weights for equity and the weight for debt. Then KD is adjusted for tax rate. So we got 8.4 percentage. Here 8.45 percentage. Equity is 800 divided by 800 plus 100. Then debt is 100 divided by 800 plus 100. Hence, the weighted average cost of capital is 8.44 percentage. Now the capital charge is nothing but the invested capital multiplied by weighted average cost of capital. So 920 is the invested capital adjusted for non-cash items multiplied by 8.44 percentage will give us the capital charge, nothing but 77.65. Now the economic value added will be no PAT 307 adjusted for non-cash items. So adjusted no PAT. So this is the okay, adjusted no PAT is same. We have adjusted the non-cash items, hence 307 minus capital charge is 77.65. Hence the total value, economic value added is 229.35. So I think these amounts are in lakhs. So 229.35 lakhs. Thank you.